brief video, we will take a look at some of the indicators commonly used to measure a bank's performance. Quantifying the performance of the commercial bank requires a look at the income statement. For a commercial bank, this can be through three parts: the operating income, the operating cost, and net operating income. This might be a little different from a non-financial firm. So in slide 38 and slide 39, you can take a look at an income statement sample for an American commercial bank. You can see that on the operating income side, we have interest income, which is the core operation of a commercial bank, non-interest income, which are fees and services and consultancies, etc., which fall under the operating income part. Now on the operating expense side, you have interest expense and non-interest expense. Interest expense is the amount of interest that the bank has to pay the depositors on whatever money they have in checkable deposits or other securities. They also have to pay interest on federal funds and repurchase offer agreements. And among the non-interest expenses, they have the salaries of their employees, retirement plans, etc. So for the net operating income, you have the income minus expense, and then you have either gains or losses on the securities that the bank has invested in, extraordinary items, and then you pay the income tax. That's how you get into the net income after tax. So as it is common with accounting, like any firm, ratio analysis has proven as a very useful way of measuring and comparing performance within the banking industry. Key among these ratios are return on assets, ROA, return on equity, ROE, and net interest margin, NIM. Now this NIM is exclusive to the commercial banking institutions. It is the interest income minus interest expense, standardized by the size of the balance sheet, meaning total assets. So the higher the NIM is for a particular bank, the more efficient it is in the asset transformation mechanism, meaning that it can borrow funds cheaply on a short-term basis and then use those funds to loan out that money and generate a high amount of interest income. Now, the ROA and ROE are common across all businesses and banks, but the NIM is exclusive to the banking industry. The slides 41 and 42 give us an idea of the general trends in the U.S. banking industry in terms of these three ratios. It only extends up until 2009 and as such is not that up to date. And also the bottom part of that coincides with the global financial crisis. So I wouldn't really put too much effort into analyzing this portion because it is not generalizable. Nonetheless, you're welcome to go ahead and read into these numbers and see if there are any patterns that stick out to you.